Good afternoon, everyone. Thank you very much for joining us today for our roundtable discussing whether private equity trusts are ripe for a rebound. And that's not a leading question, but we've got three managers joining us here in a second to discuss that. I'm doing a quick introduction on listed private equity and where we are now, setting the scene, as it were, before introducing our managers, where we're going to chat for about 30 minutes. And then we're going to open it up for questions from the audience. I'll be addressing those questions for you. So if you can put your Q&A in the box in the bottom right-hand corner of the screen. Each manager is also going to be presenting on the detail and specifics of their respective trusts next week in separate sessions. So please do sign up for those sessions if you're interested. So private equity is not homogenous. We've got three very different approaches represented here today, but they all offer exposure to unlisted or private companies. They have longer-term investment strategies and aim to deliver capital growth. But one simple distinction is that generally those trusts within the AIC private equity sector have underlying managers who control their investee companies, whilst the AIC capital growth sector, of which we've got Schiehallion here, they're minority investors in companies. And this slide tries to illustrate that there are at least 5 different approaches to private equity investing within the trust universe, of which we got 3 represented here today. In London, we're really lucky actually that we've got a very well developed peer groups in the investment trust sector, but most especially in private equity. There's around 15 different trusts for investors to choose from, and this is from the AIC's website. But also growth capital, there's 5 or 6 in growth capital too. So where are we now? Well, this illustrates that discounts have been with us for over the longer term, and the main influences on discount levels over time, I would say, are firstly external shocks, and the GFC and COVID both saw discounts ballooning. You can see that here. But secondly, performance. And over the last 3 years, the discounts across both sectors have been wider than average, following a period of rather more moderate performance over that period. The same might be said of growth capital. It's a coincidence that both of these slides, albeit with different time periods, have an average discount of roughly 25%, which is clearly much wider than the broader investment trust sector. And both sectors have seen a bit of a recovery in discounts of late, which begs the question, is this a sign that the market is getting more optimistic? Is the past any guide to the future? Well, history never repeats, but it can sometimes rhyme. During the noughties, we can see the dot-com really didn't feature. However, the 2008 bust share prices were a pretty accurate leading indicator of NAVs, albeit greatly exaggerated. The following decade was actually a pretty good one for NAVs, and with discounts having started wide, share prices performed even better, nearly doubling the NAV returns. And this illustrates another theory I have, that stability is pretty good for private equity and vice versa, as we saw on the previous slide. What this slide doesn't show is COVID, and this slide now extends the previous decade into the current decade. Predictably, COVID was absolutely terrible for share prices, but when investors realized that NAVs were accelerating in the post-COVID boom, the sector performed very strongly in share price terms. So now the last slide, we'll get on to the main bit in a minute. We're zooming into recent history, and here we can see both sectors had pretty good runs for NAVs post-COVID. You can both see some strongly upward moving trajectory in the blue line, as well as the orange line. But since then, NAVs have been broadly flat in private equity, and share prices have performed quite strongly of late, as you can see here. But on the other hand, in growth capital, it's probably a slightly more exaggerated version of the same pattern. But so far, on a sector basis, we haven't seen such a recovery for share prices. So this is the moment I now introduce you to our panelists. So Elsa, if you could get rid of the presentation. I can introduce to our panelists Lucy Majstrova, representing Schiehallion, Luke Mason, representing NB Private Equity Partners, and Richard Hickman, who's representing HarbourVest Global Private Equity. Welcome to you all, and thank you so much for dialing in today. So first of all, how does the experience of each of your trusts sort of fit with my description, and what signs are you seeing for those green shoots of a recovery? In no particular order. Luke, do you want to go first?
Of course, Billy, and thank you, and lovely to see everyone, and thank you for the opportunity to speak. So I suppose, as you highlighted, I think it's been an interesting a period, particularly over the last few years. I think we've seen for the first time the longest outperformance of public markets versus private markets. Previous to this period was about 3 quarters, whereas it's been about 3 years in terms of the outperformance of public markets versus private markets. And there's been a number of reasons for this. I think we've had macro challenges, but also weaker deal and exit environment. And even though I think the interesting thing is underneath most portfolios, including I think all 3 of ours who are presenting, have continued to grow earnings and cash flows quite steadily. And while with MVP specifically, I think what we're seeing is kind of strong underlying operating performance, particularly across our largest positions, that hasn't really come through in kind of NAV and share price growth. And in terms of your kind of a question on the recovery, I think we are seeing green shoots. Exits activity has slowly been building since 2024, and the momentum continued throughout last year, despite shocks like Liberation Day, and that effectively froze, particularly the M&A markets in the US, effectively for Q2. But actually, last year ended up being kind of the second largest year or strongest year on record for exits globally. Within MBPE, we had about $160 million of realization proceeds, which is about a 50% increase for co-investments from the previous year, at an average uplift of about 17 times carrying value, 70%, sorry, and about 2.7 times MOIC. So I think when you look at the context there, when you remember roughly there are about 20,000 private equity-backed companies globally which have been held for about 4 years or more, which are all potential candidates for exit. And there's pressure from underlying investors for these transactions to occur, and sponsors are actively looking at ways to return capital to their investors. Very quickly, kind of 3 key things from MVP's perspective. I think firstly, we have a very high quality portfolio with a number of companies that are exit ready. Average holding period is about 5.4 times. Secondly, we very much focused over the last number of years on balance sheet strength, given the uncertainty in terms of the exit market, and looking to kind of lean in and given kind of flexibility of the model, which I know we'll talk about in a lot more detail in our session next week, but kind of lean into attractive new opportunities, but also have the ability to return capital to shareholders. And then I think firstly, there's no point in having exits if you don't have the deal flow on the back end of this. And actually, the way we're positioned as a platform, we've actually seen an increase in terms of deal flow because of this liquidity constrained environment where private equity sponsors are wanting partners to help support them, whether that's in continue the growth and value creation in their underlying portfolios and companies. So I probably don't, I think from our perspective, it's been a more challenging period, but I think we are at a bit of an inflection point, and it'd be interesting to see how things progress moving forward. But I definitely, from our perspective, I definitely think there are green shoots appearing, and we're a bit more confident in terms of the overall outlook and environment moving forward. Yeah.
Great, thanks, Luke. And I guess MVP is focused solely on buyouts. So, Richard, your trust has a much broader exposure across buyouts, but also venture and real assets and infrastructure. How's that? Presumably, there have been more moving parts within yours, and have you seeing those green shoots appearing?
Yeah, thanks, Billy, and thanks for the opportunity to speak as well. We've definitely seen a quite a pronounced uptick in activity in 2025 versus the prior year. So I think in our portfolio, as you say, we do have 30% in venture and growth equity, and that's been something of a drag, I would say, in terms of NAV per share growth over the last kind of 3 years up to the beginning of 2025. But I think what we've seen, and I'm sure Lucy can speak to this better than I can, that there's a real kind of shift in the sentiment towards technology, obviously driven by the AI story. So we've started to see more IPOs come through. We've started to see stronger uplifts. Funding rounds have been completed at higher levels than previously, so up rounds as we call them. And that's so the venture and growth portfolio has really started to make a positive contribution now as of the last 12 months. So our NAV per share growth actually in 2025 was probably stronger than most investors would expect. We delivered an 11% growth rate in US dollars for the last year, which is very close to our 10-year compound average growth rate of 13%. So we're starting to see that convergence to the long-term trend.
Fantastic. And Lucy, that's your opportunity to either echo or disagree with Richard.
Yeah, absolutely. And I feel like Richard actually has done a lot of my work for me already. So I think, for growth being quite like a new asset class, it doesn't have such a long history as buyout. It effectively really started in the 2010s, and we've been investing there since 2012. But the reset of interest rates in 2022 was really the growth, let's say, GFC moment. And, Billy, you had it there on your chart, like valuations fell really sharply. It was really the valuation reset across the whole growth spectrum, but also these are typically companies that are still not profitable. So it was really hitting the business models where all the funding was taken away from the market. And it was coming after quite frenzied 2021 when the asset class was attracting a lot of tourist capital, driving valuations up. So really, we see 2022, 2023 as quite like a healthy reset. Because what happened is that the companies had to focus on their business models, sharpen their business models, focus more on profitability. And at the same time, all this tourist capital, the hedge funds and crossover investors, etc., have moved away. So we're actually quite excited about the current environment because a lot of the companies we are seeing, and we're seeing it across our portfolio, but also across our pipeline, are in much better shape. They're much healthier. They have a much better growth plan that is balanced with profitability, and at the same time the valuations have reset. So echoing what Richard was talking about before, is that we have actually seen NAV and price growth quite strongly, especially across last year, like both up around 30% for the Schiehallion fund. So we are really seeing a real momentum, but at the same time I would say when you look at these companies, which given the structure in the change in the structure of the market are effectively the missing pieces in your public market portfolio. We're seeing them actually growing really strongly, but at valuations still below their public market equivalents. So actually enormously excited about this space.
Great, thank you. And I suppose it's sentiment is absolutely everything, and that's part of the reason I suppose that discounts have been wide in the past, is that it is a niche area and it's arguably harder to understand. But so obviously if the green shoots take hold, then maybe we're back to the races, and the strong performance that everyone's seen in 2025 sort of continues. But what happens on the other side if the green shoots, if another winter sets in, then how the board and manager, how have they reacted to the deal slowdown? How are you positioned should that recovery not take hold, and activity not continue to build? Maybe Richard, do you want to start that one off?
Yeah, sure. Thanks, Billy. So we always clearly prioritize balance sheet strength. Being a closed-end fund, there's nowhere to turn, frankly, if we run out of cash. So we need to be self-reliant. We do have a large credit facility, which is $1.2 billion in total, of which we've drawn just under 600 million over the last 3 years. So we have seen that negative cash flow mainly in 2022 through 24. As I said, it turned positive in 2025, so we are more optimistic, but nonetheless, we are maintaining that large credit line. We believe we'll have an opportunity to reduce the financing cost of that credit line as well going forward. So that's an opportunity to lock in that capital for an extended period. But also, we recently announced a completed negotiation around an asset sale. So rather than relying purely on natural distributions from the portfolio, we've actually taken a proactive step, sold $300 million worth of assets. That cash will start coming in March, and then will be finished in December. So if we do experience a continued weaker period, and who knows what might happen. I mean, clearly Trump's back in the news with the tariffs again, and so who knows? But we're well positioned with that cash coming in to strengthen the balance sheet for possibly an extended period of weakness in the market.
Great, Lucy. Do you have any views on that one?
Yeah, so I think that's where the difference between the different asset classes within private equity really comes into focus, because within growth we don't use any debt on the trust level, and the underlying companies have very little or no debt typically, right? So in terms of the ongoing performance, the biggest driver really for growth is revenue growth. So what we are really looking at is the quality of execution and how well these companies can scale to become large and eventually profitable. So that's the main risk, is really the slowdown in their revenues, and that's really where we're exploiting the asymmetry of returns in growth. It's similar to what Baillie Gifford does in the public markets, that the potential upside is uncapped versus the potential downside is really limited just to the capital invested. So I would say in terms of the deal slowdown, like the way it looks for Schiehallion is that most of our companies will eventually exit through an IPO, right? When an investment goes well for us, it will eventually become so large that only the public markets can really provide the amount of liquidity. We have seen IPOs pick up, but what we have also seen is a maturation of the asset class. So we had 11 IPOs since the inception of Schiehallion in 2019, but we've also started selling into the secondary markets. And what you see is within the growth companies, the top companies really now have fairly regular opportunities to sell either to other investors or back to the company. So for example, SpaceX, one of the largest holdings within Schiehallion, organizes tenders twice a year, and we've at times taken the opportunity to sell into these tenders to trim some of the profits. Or, we've been also taking opportunities to sell some of our smaller holdings either back to the company or to other investors. So you have other ways to generate liquidity. But, this being an investment trust, we are not relying on that. There's no push for us to create these distributions. So in terms of, the main reason we're watching this is for our ability to be able to deploy capital into new, exciting opportunities. And that's where the funding we have there from the companies that previously IPO'd, which is currently around 13% of the trust, is quite helpful. But also when you look at the top holdings within Schiehallion, being, SpaceX, Stripe, Bending Spoons, Databricks, we all believe that these are the sort of names that are quite close to an IPO, let's say within the next year or two. I wouldn't be surprised if a number of them become public.
But in terms of sort of valuations, I guess, sorry, this is sort of extending the question, and maybe Luke could also comment on that. How obviously if the green shoots recover, that's great. Then valuation, how rich are valuations at the moment in the portfolio, and therefore if that green shoot goes away, would you have to like reset valuations down, or are they sort of in line with average?
I think what would need to happen. So they're very much in line with average for the asset class. Like when you look at, for example, how much the public markets value growth. So let's say with the the Magnificent Seven, they are growing. Let's say you can grow at 40-50% a year, but they are being priced at 8 times price to sales. Versus the companies we are investing in that are growing top line at around 75% a year when we're investing, and they are being valued at 12 times price to sales. So the public markets are still paying way more for growth than the private markets. That's on a relative basis, right? So I think it does give you a fair bit of a headroom, but really the main risk for valuations for us within the portfolio is not so much sentiment driven, but execution driven. So it's driven by how well these companies can continue scaling their revenues, because even on the upside, the revaluations that we are seeing broadly against the portfolio upwards, they are based really on the operating performance. You have companies like Bending Spoons, which is the largest holding in the portfolio, and it keeps growing its top line by either low 3 digits or high double digits. So you have a company that is growing really rapidly, and the valuation uplift is driven by fundamentals. It's not driven by multiple expansion. So this is really where we're watching the execution.
Luke, so I guess in the same thing, are you saying valuations are they attractive at the moment, and how have you how's the board manager sort of reacted to that slowdown?
Yes, I think, and I agree to a certain extent with what you said. In terms of from our portfolio, I think interim results, the value, we had a portfolio valuation was valued about 15.4 times EV/EBITDA, but on a weighted average basis. And if you take that in context of the listed markets, so take the S&P, it's roughly on similar basis, about 18 times. So actually, we're not claiming the portfolio is cheap, but it's priced relative to public markets, particularly you consider the discount as well. But clearly, crucially from our perspective, that's very much across different subset sectors. Often we're and slightly different profile of businesses, often sector leading names in some software, healthcare, and business services, growing, revenue and EBITDAs of double digits year on year. I think from our perspective, very similar to what Richard was saying, focus on balance sheets is incredibly important. From the trust perspective, we do utilize gearing at the trust level, but actually what we've been doing over the environment, and particularly an environment over the last few years with greater uncertainty in terms of realizations, distribution, etc., we have been delevering the funds. So, typically we are on a run rate basis, typically around 105 to 110% invested. But actually we've reduced that all the way down to only being about 1% geared. And actually the model is differentiated from many listed peers, and the fact was because of the co-investment approach, i.e. we're investing alongside GPs, taking stakes directly in businesses. We don't have any unfunded commitments. So actually we have, available liquidity of about $300 million. And it's very fee and capital efficient. And what I mean by this is that we pay no fees and no carry on the underlying investments we make, but actually we're able to start and stop investing when we like, depending on the environment. So actually we're able to build the portfolio investment by investment from the bottom up. And crucially, just to your point of kind of risks, and I know people talk about leverage at the portfolio company level, and this is slightly different from the growth perspective, but actually in kind of more mature kind of buyout names, actually, managers do use leverage. And on a weighted average basis, the portfolio sits at about 5.4 times net debt to EBITDA. And ultimately what this means, actually that's broadly in line with the broader market. And it's something that's very important, crucially, when we're looking at these companies, they're very, cash generative, profitable businesses, which are the significant tilts, kind of technology and business services that have kind of high recurring revenue and good visibility of earnings. So actually, from our perspective, we're very comfortable with how they're positioned. And it's something that we spend an awful lot of time looking at. One is the value when we're going in, but actually we do look at the kind of leverage levels and when we're doing our due diligence and making investments. I think just in general, as you said, if the environment doesn't improve and we stay in this position we are today, actually the flexibility of the model allows us. I think we're in a relatively good position. I talked about the maturity of the portfolio, but actually we continue to, and I know we'll come and talk about this in terms of kind of capital allocation, continue to make new investments, but also we pay a dividend and also buy back shares as well as we move forward.
Richard, are you in the same? I mean, presumably you've got a portfolio across the whole spectrum. So are you allocating capital more or less towards particular areas?
I probably can give a fuller answer in the specific kind of presentation next week on this, because we do have a very diversified portfolio, a whole range of investments that we make. But very quickly, we are allocating through our separate managed account to secondaries and direct co-invest as well as the primary funds. So we kind of capture a little bit of what Luke was referring to there in terms of the co-investment side, which is obviously MVP specialism, where we have the low fees and the flexibility to deploy to specific names. But we also benefit from the primary side, where we have exposure to some of the top performing general partners globally. So for those who are less familiar with the terminology, primary funds, in our case, refer to HVP making commitments to underlying third-party managed funds. So the likes of Index Ventures, Accel Partners, Bain Capital, Carlyle Group, and others. And many of these GPs, some of them are kind of well known, many are really not at all to the general investing public. So there's a whole range of managers that we work with. But I think continuing to commit to particularly the venture and growth equity side over the last 3 years, when frankly it was out of favour, has kind of put us in a good position today, because we have been backing those companies that are emerging as the new winners in this new economy. So we are committed to continuing to deploy. We've deployed very steadily right through the last 5 years. If you look back at our capital call figures, we've been investing between $400 and $500 million a year very consistently, whether the market's buoyant or kind of less so. And I think that averaging effect, the dollar cost averaging, we're continually investing at low prices as well as higher prices, does help maximize returns in the real world, where we can't know for sure, of course, what the future will bring. So it's a very, very much steady as she goes, business as usual approach from HVPE and capturing opportunities across all the segments.
Great, thank you, Richard. But I guess one of the things about private companies is that and one of the advantages, I suppose, is they're able to operate without, outside of the glare of sort of public attention, or at least certainly less than publicly quoted companies. And as a result, some of the companies in the portfolios are sort of relatively unknown. Obviously, some are very well known. Lucy, I'm not going to harp on about that one, but can you give an example of sort of either a company or some companies in your portfolio, how they've delivered value over the period that you've owned them, and how they could be potential sources of liquidity for the trust in the short to medium term? And obviously, you don't have to pick one that's about to IPO now, but I just thought it might bring the portfolio and the value that private equity managers, who are often much maligned in the FT and things, they are actually rolling their sleeves up and influencing these companies. So have you got an example in your portfolio? Lucy, do you want to go first on this one?
Sure. So I would say broadly we have two types of companies within Schiehallion, right? And in the first camp would be the companies that everybody knows the names, the SpaceX, Databricks, Stripe, but it's actually hard to gain access to them. And that's where our reputation as supportive shareholders, long-term shareholders, and our ability within our public mandates and to hold post-IPO is hugely valuable. But, let's not shy away from it. SpaceX has done incredibly well for our shareholders. It has delivered huge return. It's a fantastic company, and it's basically created a new market and become a monopolist within it. They have bent the cost of launch downwards so rapidly, and essentially when we first invested, Starlink and the idea that you would be able to get internet in the middle of an ocean sounded like sci-fi. Now it's a reality. The next leg of growth for them is when Starship is fully operational, so that's the next generation of the rockets, again will decrease the cost of launch so much that the cost of producing or manufacturing in space and building a manufacturing in space is going to be similar to building a manufacturing facility in the high-tech regions of California or Taiwan. So there's a huge potential still for the company. Now, it's becoming valued as such, and that's why we've been trimming a little bit. But then you have the companies that have grew outside of the VC universe, and they might be not so well known by the VCs. And I think a fantastic example of that is the Bending Spoon. So it's the largest holding within Schiehallion. It's a company we invested in 2023 at a valuation of less than $1 billion, and now it's valued at over $11 billion. And it's a company that's quite unusual because it's an Italian company based in Milan. And essentially what they do is that they have developed a platform of integrated tools and a world-class team that can buy a digital product company and make it run much better. So these companies that they acquire, they typically have a subscription-based loyal customer base, but they have been somewhat undermanaged and they have been not growing quite as much as the previous owners have hoped. So the examples would be the likes of Evernote that we invested in. It's a note-taking app that's been much loved, had a big user base, but never became profitable. So what Bending Spoons did with it is that they brought it onto their platform, they stripped most of the cost out, and they basically rewrote the whole code. They made it much more reliable, much faster, much better, but also optimized the pricing. So very quickly, they moved it to profitability and the cash generation. And then they used the proceeds from the previous acquisitions like Evernote to keep buying more and more companies. So I think this year they've been in the news a lot because they've been buying big names like AOL or Vimeo Eventbrite, Meetup. And honestly, that the quality of execution within the company has been really exceptional. They are doing incredibly well, but I would say the main product there is really their ability, the team's ability to be able to pull off these acquisitions at an increasing size and increasing base. So it's a company, a good example. I believe you've been asking for a company that maybe might not be quite so known, even though it's been cropping up in the headlines lately, but that has done incredibly well for our shareholders. And it was really our ability there to find these companies, but also to offer them, you were hinting at the sort of what's the value added. And for Baillie Gifford, it's really, we are very attractive for companies that are ambitious. They want to build something that is a standalone company. They are not looking to be acquired. And they want to IPO one day because they know we can help them on the journey and then potentially back them with further funds post IPO. So this is where the partnership works really well for us.
Great, thank you. Luke, you obviously got a less heroic risk return or return objectives. Have you got any examples in your portfolio of things that have delivered or where NB have really added value for shareholders?
No, and thank you. I think I like what we mentioned at the beginning. It's actually it's what we look to do. Obviously, we invest alongside leading private equity managers in their kind of area or sector specialists in their area of expertise. And when we're talking around today, it's very much when we're talking around kind of value creation, and that's simply what that means is the ability for a private equity manager to go in and change or improve a business that they buy. And it's very much kind of skills, we're talking about skill-based factors rather than market-based factors. And what I mean by this is very much kind of rather than kind of just the market through multiple expansion, the market growing, actually what really matters today is very much kind of private equity sponsors who can drive operational improvement, pricing and M&A. And I think what we're really leaning into, as I mentioned, is kind of backing strong sector specialism and proven value creation playbooks for, say, bolt-on acquisitions. It's where we like add-ons because they bring different synergies. You can buy a company that brings a different product or enters a different geography and really can compound value over time. A great example of this is Mosaic, slightly less sexy than some of the names that Lucy's been talking around, but it's a US wealth management platform. It benefits kind of from real scale in terms of the independent advisory channels, delivered kind of strong organic growth, helped by continued kind of bolt-on M&A transactions of small advisor business, but actually deep existing relationships where they're existing advisors. And it's translated into very positive revenue and EBITDA growth across well ahead of kind of the portfolio averages. Also, what we actually are finding is that in this more challenging environment, what some private equity managers are doing is having partial realizations or partial sales of positions. So Mosaic actually has already been a source of liquidity. We have had a partial realization of that, where we've realized at an uplift to carrying value already. And the remaining stake that we have within all the many investment we have has continued to perform very well, both from a realized and unrealized value. And then obviously the largest investment in the portfolio, Action. I think everyone knows Action very, very well. It's been a very consistent, continued strong rollout across Europe, strong like-for-like performance with disciplined execution. From our perspective, we've seen strong earnings growth and repeated uplifts in valuation. Again, we've participated in two realization events over the last number of years where we've proactively decided to take money off the table from a portfolio construction perspective, not wanting that one position because it's grown so much to be outsized in the portfolio. And so actually, and I think from that perspective, we have been, we very much still like the business, but actually we decided to take a bit of cash off the table at that point in time. So I think the other thing to kind of mention is actually about 42% of the NAV of the fund is in our top 10 investments. So they are really driving the growth. And as you said before, I think from our perspective, it's likely to see over the next 6, 12, 18, 24 months, although I can't name specifics in terms of names that we're likely to see realizations or distributions from in due course. There are specific names that we have got a number of things in the portfolio that's likely to exit in the near term.
Great, thanks, Luke. And Richard, I guess your portfolio is very much more diversified than the other two, and I guess that's part of the strength of the model. But are there any companies there that you could highlight that sort of have contributed significantly to HVP or?
Yeah, sure. So it's always a difficult question for me because, as you say, Billy, our portfolio is much more diversified. So in contrast to Luke's figures just there, our top 10 is only 8% of NAV. We have effectively 1,000 material private company holdings in the portfolio, and clearly we're a global investor, so many of them are not well known in Europe or the US. But just to pull out a few, and from our top 25 list that we do publish every month on the website, just to give a regular update on this, the largest company we have as a percentage of NAV is only 1.7%, which is Shein, the fashion business that I think many kind of viewers will have heard of. That's been a spectacular growth story. It was actually a part of a secondary portfolio that we purchased back in 2017 from an Asian VC specialist. We purchased that portfolio at a 30% discount to NAV because there was very little competition in that market at the time. Shein was one of many companies. There were more than 100 portfolio companies in that kind of basket of funds that we purchased. And that's grown from virtually nowhere to becoming our largest holding. So, clearly it's been very, very incrementally beneficial to the overall NAV of the fund, despite just being one holding. Clearly, there are challenges there in terms of the ongoing attempt to IPO the business. We are optimistic that will eventually conclude positively, but we're certainly not reliant on that, and it continues to do very well in terms of trading. And we also, I won't kind of repeat what other my kind of colleagues have said here, but we also have the less kind of well-known, perhaps the less publicly represented holdings. One of them, I suppose, worth highlighting is Visma. And I'm happy to credit HG Capital with this. Clearly, they have a listed fund of their own, so not promoting that fund, but worth checking if any viewers are particularly keen on SaaS exposure. But Visma has been an incredible story over a 20-year period. HG invested back in 2006. We've been a consistent backer of their funds. The enterprise value of Visma at the time was 500 million euros. It's now north of 20 billion euros. So spectacular, kind of very steady growth. It's for those who don't know it, it's an accounting software focused platform business. So provides the kind of less high profile end of the technology market there for enterprises, and really has done incredibly well over time. So what we're looking for clearly is managers who can deliver consistent performance through those types of exposures.
Fantastic. And now to sort of, I guess, final wrap before we come up to Q&A. Deal activity comes back or doesn't, but underpinning everything is really the underlying performance of the companies. And so, how briefly, I guess, how have your underlying companies been doing? Obviously, there's all sorts of different macro influences on that have been cropping up. But what would you say are the sort of key influences over the next year or so for your portfolio, if there is any? Maybe they're too diverse to pin anything down. Richard, do you want to address that one first, or is it?
Sure. Yeah, as you say, it's a difficult question, but clearly, I think in common with other listed funds in our space, I think we would benefit from stability in the macro environment and the geopolitical environment. So let's hope the current the news flow kind of subsides over the next few months. But I think we are clearly seeing stability in interest rates and potentially further falls there if inflation remains under control. That would certainly be helpful. Although I should stress, private equity can do well in periods of interest rates at kind of 4 or 5% as we've seen. I think a revival in the IPO market would, I think, be a helpful signal to investors that normality is returning. To be clear, it is not actually a particularly important exit route for HVPE or for many of us on this call. I think we see typically in a good year only 10 or 15% of value being exited through IPO. So it's not that we need that to happen, but I think it's a bellwether for the broader market and appetite for portfolio companies. So that would be helpful. And as I say, continued stability would be appreciated.
I'm not sure that's not directed at anyone in particular, Richard, but
No. I realise that that's the way it might have come across. I'm not. None of us has control over it, but let's just hope.
Luke, have you got anything to add to that?
No, I very much agree with Richard's. Stability is key. I think I very much just reiterate the point you made about actually the different types. Everyone thinks we need a buoyant IPO market for actually a lot of our companies to be exited. Again, it's more around sentiment. Whether sell to a strategic buyer or sell to a sponsor is primarily the method or way that we exit a lot of our businesses. Particularly MVP focus more on kind of the mid or upper mid market. So actually you have 3 different types of exit routes. I think is really important. But again, sentiment stability is key. And also, ultimately, we need our sponsors to execute. We need these value creation plans to continue to be put in place. A slightly maybe a falling interest rate environment would be more positive in terms of debt being cheaper. But actually, as Richard highlighted, actually private equity can still perform well in a higher rate environment as long as the companies are still growing. And I think it's the same for all of our portfolios. Actually, despite NAV growth actually being relatively sluggish over the last few years, or kind of more, lower than long historic averages. Actually, the underlying portfolio growth, on a revenue and EBITDA perspective, has been kind of companies that continue to grow. Again, if you focus on our top 10, we've seen kind of revenue growth of about 14% and EBITDA growth about 60% over the last 12 months. They're still growing strongly, and that needs to continue to happen. And if we get kind of a more buoyant exit environment, the hope is that we'll still start seeing these companies being exited and then recycling this capital into new transactions and new deals, hopefully drive NAV growth and share price growth moving forward. So yeah, I think we are of similar minds. Stability is very important. And yeah, I think the hope is that we'll get that this year and allow these green shoots to continue.
Lucy, anything to add there?
Yeah, I mean, I would, I don't want to reiterate anything on the hope for not a big macro shock, but I would say overall similar. Just all the companies are performing really strongly. And what I would say, what's quite important, there's not one single driver for it. There's so much attention focused on AI. Clearly, some of the companies are riding on the tails of it. But, there's defense companies, there's a beauty company, it's quite a broad portfolio. So it's not an AI portfolio, and it's not narrowly tech portfolio either. So overall the average revenue growth within the portfolio is close to 50%, which is double what you are seeing on the Nasdaq 100. About half of the portfolio exposure is to profitable companies. They have long cash runways. So we just need this environment to continue. We need to see them continuing to execute as well as they have been. And this is a really fantastic runway for them right now. And, for Schiehallion specifically, we also believe it will be included in FTSE 250 from March. So there's nice positive catalysts in the next year for us. So I think we are quite optimistic, but again, let's hope for not a big macro shock.
I think we're all aligned on that one.
Yeah.
Thank you, guys. That's been really, really helpful. We've overrun a little bit, but we've still got some time for questions. There's one that's come up, which interestingly is quite technical, but I think actually it sort of illustrates the point that the US is such a massive influence on everything, and in particular private markets. But can you, given all of your underlying portfolios are pretty heavily exposed, I guess, to US dollars, what is there any active policy of hedging the US dollar GBP exchange rate, and has the FX impact been positive or negative in the last 2 or 3 years? So anyone, I expect your all answers will be the same, but Richard, go on.
I'm happy to start. Yeah, thanks, Billy. So we have around 60% of our portfolio in North America, and because many of the non-US funds are denominated in US dollars, actually our US dollar exposure is 80% of NAV, so probably very relevant to us. We do not hedge the currency in a systematic way. There are individual deal situations where there's short-term hedging between kind of the negotiation and the close, but there's no overall strategy for HVPE. And that's quite deliberate. We have considered this multiple times over the years. I think for us, it would be very, very difficult to achieve a very well-balanced hedge, given the complexity of the portfolio and all the moving parts. So, for example, should we hedge at the underlying fund level or at the portfolio company level where revenues might be generated, in another jurisdiction? So we prefer to leave it kind of natural, so to speak, and let shareholders make their own decision in terms of currency exposure and hedging. I think it's probably cleaner and easier for everybody to to manage.
Great. Luke, any difference?
No, similar amount of exposure to Richard, about 68% of the portfolio is North America with 22% Europe. And then again, get a very, very similar response. We've looked at it a number of times in terms of hedging, but actually from our perspective, feel it can be incredibly complex and move around a lot and be very expensive. So we'd rather just, be in terms of kind of say, look, this is our dollar exposure, this is our euro exposure, and let clients know, that if they require to want to hedge at their level, then fine. But again, at the trust level, underlying portfolio level, it's very difficult to do.
Lucy, anything different?
No difference there. We don't really hedge. About half of the portfolio is denominated in US dollars. I don't have the stats for revenue exposure, but I suspect it will be higher than that.
Okay, one last question at the moment anyway. How strong is the case for share buybacks for private equity trusts like yours? Lucy, do you want to lead that off?
Sure. So we do share buybacks and we look at them as a capital allocation policy. So today the discount is around 14%, which is much tighter than it has been. But there were times in not so recent and not so distant history with Schiehallion when we could be buying our own portfolio at more than 50% discount. So that felt like the best use of shareholder capital at the time. I think I would say the current, at the current discount level, the argument for that is much less clear. But we're really looking at them from capital allocation perspective.
Great, Luke, have you got any thoughts on that?
Very similar in terms of kind of, as Ben, I will talk a bit more detail about the flexibility of the model next time. But actually, from our perspective, we have two pillars to our capital allocation framework. The first is allocated capital to the investment program, which is the principal use of capital and the main driver of NAV growth. And the second is returning capital to shareholders, both through buybacks and the dividend policy. And I think from our perspective that you might have seen that the board announced an update to the capital allocation framework at the beginning of last year, so February 2025, allocating about $120 million to buybacks over the next 3 years, if the discount remains where it was. And actually there was a further update in November this year, just highlighting that actually it's likely that we expect to deploy that capital faster. And just to give you a bit of an example, at the end of November, we'd already deployed about 3 million shares, bought back 3 million shares, about $60 million worth in terms of value. And very similar to what Lucy was saying, what we're trying to do is and the flexibility and use the capital between kind of making new deals, buybacks, and the dividend. The dividend pays 3% of NAV out on a semi-annual basis. The kind of current yield in terms of the share price at the moment is about 4.5%, but it's to get the best risk-adjusted return for shareholders. And we are very aware that buybacks at these levels is accretive to the NAV and positive shareholders. But actually, from our perspective, it's working out at what point, what's really going to drive NAV growth moving forward is making new investments. But we're very aware that buying back shares today is also accretive as well. So there's a balance between all three, or the two pillars, make the new investment pillar and also returning capital to shareholders.
Richard, have you got more than two pillars, or are you?
No, very similar actually. I won't elaborate much more, but we do have a mechanical approach actually to allocating capital to share buybacks. So we have a 30% allocation at the moment of all of the cash that comes in. 30% is allocated to what we call a distribution pool, which can, in principle, be used for potentially a dividend. We don't pay a dividend today, but potentially in the future, the board could consider that. But at the moment, they are deploying that capital entirely via share buybacks, given our shares trade at almost a 30% discount to NAV. So it is a very sensible use of marginal cash. So on a monthly basis, we report that 30% allocation going into the pool. And I should confirm as well, the secondary sale, the proceeds of that sale, the $300 million, 30% of that will also go into the pool. So it's captured within the mechanism, so $90 million over the next year, in addition to the natural allocation from portfolio realization. So we're absolutely committed to ongoing buybacks. Clearly they're accretive to NAV per share, beneficial for shareholders. So fully agree with my fellow two panelists.
Great. And one last sort of parting question is there's a lot of stats about how companies choose not to list these days and stay private for longer. Sort of playing it the other way, a lot of investors have a large chunk of their portfolios in public markets. So how much, or is there an idea, or maybe it's obviously not investment advice, but how much would what sort of allocation would you expect a private investor to have to private markets, or is that an imponderable? Or to other clients that you have who are maybe bigger, sovereign wealth funds, what percentage do they typically have towards your private market, or what part of private markets what percentage of their portfolio is allocated to private markets? Anyone want to brave that one? Or you got to get on the phone to your lawyers first.
Yeah.
Lucy, did you want to go?
Yeah, I'll happy to take that. I don't want to put a percentage on it, but I think what I would say is this trend is going to continue. Growth, within that, growth has become a $6 trillion asset class. When you look at some of the biggest companies within that, if they were listed, they would be some of the largest companies in the world. So I think for somebody looking at a full portfolio, it's become impossible to ignore. So without putting a percentage on it, I think if you want to be exposed to what's happening in the world, you can't ignore, why wouldn't you look at this part of the investment universe?
Nicely put, Lucy. Anyone else got anything to add on that one? Oh, you seem to have.
I think it's just interesting to see. I think when you're looking at maybe the Mansion House reforms and the for DC pension schemes and how the government actually has changed and saying, look, they want up to 10% of allocation into private markets moving forward for the schemes. I think adoption of private markets in the UK is behind. Very much behind the US and Canada and Australia, for example. So actually, I completely agree with what Lucy says. Actually, companies aren't coming to market. So actually, if you want exposure to exciting, higher growth, businesses, you have to look at the private. But actually, very boring but high quality companies are staying private for a lot longer. So actually, I think it's really important. But I think we are naturally going to see a shift, and you're hearing a lot about the Mansion House reforms and the Mansion House Accords, and actually how pension schemes and DC schemes particularly, you'll start seeing an increased allocation to private markets within those. And so actually, and I think a lot of it is about education. There's obviously been a lot of, there's complexities to what we do. Private markets is always talked in a slightly strange language, but actually as things become more normal, people will start seeing, actually, I'm holding unlisted investments in my SIPs or in my pension. So actually, should I be holding in my ISA? And to the point, I'm not going to put a percentage on it, but having a diversified portfolio and having things that are able to drive the portfolio at different moments in time, I think is really important, as many people know, for a broader portfolio allocation perspective.
Richard, your opportunity for the last word. Yeah, so thanks, and not a huge amount to add, but perhaps I can couch this carefully as saying, look, what I've seen or what I've heard in the market talking to investors over the years, there's definitely a trend towards an increased level of allocation. So I think the UK wealth managers in particular are starting to embrace private markets through various structures, including listed. And so, to the extent that viewers are themselves wealth managers or clients of wealth managers, I'm sure you'll see this if you haven't already, that there'll be more noise around private markets exposure kind of coming through. And of course, there's the well-established and well-known trend among US endowment funds and some of the sovereign wealth funds that they have very large allocations to private markets, sometimes north of 20% of their total assets. So So I think the range we've seen is very much 0 to 20% plus, and it's drifting from our perspective in the right direction.
Fantastic. Well, thank you very much on behalf of all the listeners to you three for your insights. And just to highlight to anyone listening that HarbourVest Global Private Equity, NB Private Equity Partners, and Schiehallion, if I'm pronouncing that correctly, will all be having separate sessions next week to dig into the real depth and the detail of what goes on underneath their bonnets. So please dial in for that. Thank you so much for presenting so eloquently, and thank you all for dialing in. So thank you very much. Have a good day.
Good afternoon.
Thanks, everyone.
Thank you.
Take care.